Hey everyone, welcome back to the channel. Today we're diving into one of the most talked about topics in investing, stock market corrections. You've probably heard the term thrown around whenever the market drops, but what actually causes a correction? And why does it happen so often? Stick around, because by the end of this video you'll not only understand the causes, but you'll see why corrections aren't always something to fear. So let's break it down. A correction is basically when the market falls about 10% or more from recent highs. It sounds like a big deal, but in reality, corrections are completely normal and happen regularly. The first thing to look at is the economy. Interest rates, inflation, and economic growth all play a huge role. When the Federal Reserve raises rates, borrowing becomes more expensive, slowing down businesses and consumers. Inflation can eat into profits and lower demand. And when signs of a slowdown appear, like weaker GDP numbers or rising unemployment, investors take a step back. Valuation is another driver. If stock prices run too far ahead of company earnings, the market eventually has to cool off. Investors lock in profits, selling snowballs, and before long, you've got a correction. But here's the thing, numbers aren't the only factor. Psychology matters just as much. Fear spreads quickly. A negative headline, a weak earnings report, or just the feeling that stocks have gone up too fast can flip sentiment. Once selling begins, it often feeds on itself, amplified by algorithms and traders reacting to price drops. And of course, big external shocks can push markets lower. Wars, trade disputes, pandemics, natural disasters, you name it. Even scandals or the collapse of a big company can ripple through the system. Add in technical factors like margin calls or big money managers shifting out of certain sectors, and corrections can hit faster than most people expect. But here's the key takeaway. Corrections aren't all bad. In fact, they're healthy. They reset valuations, clear out speculation, and bring the market back in line with fundamentals. They rarely last long, and history shows the market always recovers and moves on to new highs. So next time you hear the word correction, don't think panic. Think of it as the market's way of taking a breather. If you found this breakdown helpful, hit that like button, subscribe for more investing insights, and drop a comment letting me know if you've ever experienced a correction firsthand. Thanks for watching, and I'll see you in the next video.